Welcome back to DASAR. My name is Darshan Doshi, and today's podcast is about investments, about personal finance, it's about money. I have a fantastic guest with me, Mandar Mhatre. He is the CEO of Apex Fund India. Welcome, Mandar.
Thank you, Darshan. Nice to have you.
Thank you. So today we are going to talk on a whole range of topics. Mandar is the CEO of Apex Fund India, but he's also an investor. He's been an entrepreneur. He's an author of a book on finance and on money, and he's also a teacher. So we have someone who's got a really rich experience being a fund manager, being on the back end of how a fund runs. You've done so many things in your life, right? You've been an entrepreneur. You're running Apex Fund India. You've written a book, this book called Papa Don't Preach, right? Maybe we'll first start with the book.
Sure.
Because, personal finance, money, wealth is an important topic within DASAR.
Sure.
So maybe you can share a little bit about what made you write this book.
Sure.
What is this book about?
Sure. So the inspiration for the book was really, when I was standing in one of the bank queues, right? And what I saw was the banker sold an really old gentleman annuity product saying this product returns 36% per annum. Right? That piqued my curiosity. I was wondering which product returns 36% an annum. And when I looked through the product, it was really an annuity product clearly missold to an old gentleman. Right, and I found examples of this time and again, not just in fixed deposits or within the bank, but obviously in the equity markets, in mutual fund space, in insurance space. A lot of friends would come to me, ask about what do they do about specific money, right? And that was really the thought and the genesis of it. What I feel is that unfortunately there are too many papas who preach you about money. Right, and if you basically break down finance into its basic, you really can understand it. You can make decisions for yourself and at least ensure that you are not fooled by others.
Right? This is a trust-based industry, money
Absolutely.
management. But at the what we keep hearing are, the stories like you suggested, products being sold, expectations, higher expectations or misrepresentations being made.
Absolutely.
But, at DASAR, and personally, I believe you need to take control of your own money. You can't delegate. This is not a topic that can be delegated onto someone else, right? So just wanted to understand, what are some of the things that you've discussed in this book about money management.
Right. So this book is purely focused on what's available in the Indian market. It starts by looking at the most basic product, fixed deposits. Then there are few concepts within fixed deposits which people need to be aware of. Then it slowly moves to more interesting product. It moves to corporate deposits, mutual funds, equities, insurance, annuities. It also talks about how do you manage your debt. What happens if you have fallen into a debt trap? How do you manage credit card? How do you deal with agents and advisors? What are the questions you need to ask them? It also looks at a bit more funkier asset classes. It looks at startup investing. It looks at art as an investment, whether diamond could be an investment option or not, right? And then eventually dovetails into talking about how do you build wealth over a long period of time? How do you think about wealth? What are the first steps when you're thinking about wealth? What do you do? What do you not do? Once you started to accumulate wealth, how do you ensure that wealth goes? And eventually, how do you distribute that wealth? Because, everybody who is going to die is not going to take money up with him. So, how does that wealth get distributed either via charities or via certain other structures in a way which is efficient? And if you are very lazy, then there's a last chapter which has literally 10 points which you must do, right, to improve your financial health, right? It covers, it takes about 2 pages, but
it's a basic checklist.
It is basic checklist.
Awesome. I have so many questions and, particularly I'm a big fan of many books, The Wealthy Barber,
Sure.
The Richest Man in Babylon, The Psychology of Money by Morgan Housel. I mean, these are classics.
Absolutely.
But one thing that's common to all of them is they speak about money from the point of view of being an American.
Right.
I've not found a lot of books that focus on India. So I'm very happy, first of all, that you've taken this initiative to write about money management for the Indian customer or an Indian consumer, let me put it that way. What does personal finance, what does financial independence mean to you?
It means choices, right? What it allows you to do is to do work which you really like and do it without having to bother about where your next meal is going to come from, right? Money by itself really doesn't mean anything. All the possessions in the world by itself really don't mean anything. Right? But having said that, if you've got a family, you've got kids, you have to start thinking about how you're going to at least do enough justice to maintain a certain standard of living for them and to provide them a certain level of education. What money will do is will allow you to make these things or make these things happen even as you remain very happy with what you are doing in your life, right? So in my mind, taking care of money is as good as giving optionality in life.
Incredible. Now let's talk about fund management and the whole sector, not just in
Sure.
India but the US. You're the CEO heading Apex Fund India.
Right.
For those who don't know what fund management is, what
Right.
goes into running a fund, and how does Apex or how does the company that you
Right.
lead help them?
Right. So, let me just simplify it a bit, right? In the simplest sense, fund management is about raising money from investors and then deploying that money in various asset classes, right? Now, these asset classes could be direct equities, it could be bonds, right? So, these are usually listed and liquid. It could be unlisted space, which is private companies. It could be in startup space. It could be in funkier asset classes like bitcoins or even gold or even any of these commodities, right? And there could be multiple strategies involved around it, right? There could be trading strategies, there could be investing strategies, there could be trend following strategies around it, right? So that in nutshell is your fund management industry, right? But however, to make this happen, there are a whole bunch of other elements which you need to take care of. Starting from putting a structure, meaning in some legal entity or some legal form, that money has to come in. Given that there is fiduciary responsibility of fund managers, many of the countries have regulations around it. So ensuring that those regulatory requirements are met, right? Once the money is getting deployed, ensuring that there is right amount of governance around it so that the frauds don't keep on happening around it. Right? There is ensuring that there is a third party independence when it comes to reporting of this money, and then eventually distributing this wealth, whichever is generated, back to the investors and taking care of it. So there's this whole gamut of activity which is there. We at Apex effectively tell our managers that there are only two bits which we wouldn't do for you, which is one, raising capital for you, and two, managing money for you. Having said that, we do that for some of our clients in Europe, right? We're still not doing that in India. But these are essentially the two aspects of the business which we wouldn't do. Everything else is what we would do. Right? So what it allows a fund manager to do is really focus on where their real strength is, which is managing the relationship and then managing the investment and thinking about it 100% of time, not really bothering whether the NAV or whether the net asset value calculation is correct or not, whether the investor has done KYC, AML or not, whether the regulatory reporting has happened or not, whether the audit has happened, whether the financial reporting has happened. We'll take care of pretty much everything else.
Incredible. The thought that comes to my mind is Angel List. Angel List started by Naval Ravikant, kind of democratized investments in startups.
Right.
And so today in India, you can start a syndicate whereby you get startups, you identify startups that you're going to invest in, and you find people who want to invest alongside you into those startups. And Angel List kind of takes care of all the back end, which includes the documentation, the regulation, and the KYC and all. So can I say, but applied this to much larger sums of money?
Look, what angel list does is really a small part of it, right? And typically it's part of the investment management process. It is due diligence, it's legal documentation, which any typical VC funds needs to do because it's part of investment. What we would be doing is substantially broader. Effectively, what we say to people is that we will manage your business, right? We will take care of all those nitty gritties. You got 10 staffs, you need to take care of their payrolls, we'll take care of that. You need CFO, CEO services, we'll take care of those services, right? So it's much broader, than what an angel list would be doing. Also, the objective is very different with angel list and versus us, right? In typical angel list type of syndicate, you would have a lead investor who, apart from his stake, will have optionality to have upside into the deal as and when it materializes. Right? Whereas we don't have that. We work on flat fees, or we work it as percentage of AUM in terms of the deals. Right? And the third bigger aspect is we are independent. We don't get bullied by the fund managers. Our allegiance is to the investors of the fund. Right? We ensure that whatever they are saying is right, is proper. Right? Our allegiance is towards the regulator, so to show them the correct picture of what's happening within the fund and all the compliances are met.
Mandar, my next question to you is, you've got such a bird's eye view, a 30,000 view of various funds being managed, equity, startups, venture capital, micro VCs, in India, in Europe and the US. With increased liquidity, what are some of the differences that you are seeing in fund management in India versus the West?
Right. So broadly, the big trend, as you rightly pointed out, is there is liquidity. So funds are able to raise a lot of capital. Sometimes the closing becomes a bit of a challenge simply because meetings are not happening face to face, and what would have closed within a month typically now would take 2 to 3 months. It's a fairly common trend which we see with Indian funds. It's not so common with US and European funds because meetings are still happening in those places. Secondly, the big trend is on the ESG side of it. The first question with any European or any US fund is, are you ESG compliant? And if the conversation is, or if the answer is no, then the conversation goes downhill with it. Whereas in Indian funds, that concept is still catching up. From a broader trend perspective, what we see is that Indian funds are about maybe 6, 8, probably even 10 years behind where US or European funds are in terms of evolution curve. So there is going to be a catch up which is happening, and it's same trend within the startup space as well, where you've seen now entrepreneurs as well as investors who have seen 3-4 cycles of entry exits, which is missing in the Indian market. India is just seeing probably the second, or it's at really very early stages of third cycle. So that investor base is still not mature within the Indian ecosystem. As this matures, the industry will also mature. So that's the big difference which we continue to see within the space. From an India perspective, it's the usual suspect. It's real estate, it's private credit, it's growth capital, which is able to raise money. We do see a lot of increasing PIS activity. That industry is now almost 25-30% of the mutual fund industry, and it's grown very rapidly. It was non-existent pretty much in 2010, 2011, and it's just growing very, very rapidly. What we also tend to see is that a lot of investors or a lot of micro VCs coming into play. About 3-4 years back, there were 2 or 3 big names within micro VC space, but now pretty much we've seen 8-10 different names. We are seeing these micro VCs managing to raise substantial amount of capital in play there.
Incredible. Fantastic insights. Now, my next question is, I don't know if this is a myth or is it the truth. Do you get higher expected returns either from equity market or different asset classes in the US versus India? Is that true?
See, it's a difficult one to answer, frankly. Right. What is interesting though is if you look in both markets, right, there are X number of days which has generated you in positive alpha. So if you look from an Indian market space and look at data of last 20 years, had you been out of this market for 30 days in those 20 years, your returns would have been 0 or almost negative. right? So those 30 days you had to be in the market to make money from a long-term perspective. What I personally have seen is retail is typically absent on those 30 days. They are moving in and out of the market, hoping that they'll make money on trading, and it eventually never happens. Right? Retail has absolutely no advantage trading in market. If you look at any of the largest hedge funds or any of the largest trading houses or any of the largest investment banks, they are putting billions of dollars in technology to trade market. By the time retail sees that price, it's history. They are seeing a price which is 10 seconds late because of latency, because of internet issues, and because of other challenges. Right? By then, the trade has happened, executed, and somebody's already made money. Right? So retail, if they are making money on trading, it's pure luck. Luck doesn't stand on for a long period of time. Whether it's US or whether it's India, it's pretty much same. Having said that, what we've also seen is growth of Twitter, Instagram traders, right? Or growth of traders which are now using private chat rooms to pump up the stock. We've seen a couple of examples of those happening in US markets. We do hear about those in Indian markets, right? But those in my mind are really fads. They work for some time and then they just basically stop working, and everybody loses their pants.
Right. I think as an individual investor, right, who would like to invest himself and make money, right? I think time is the only asset that I have on my side.
Absolutely.
Right. And so you consider yourself as a value investor. So, what would you kind of say for someone who's in middle class income, Indian, and wants to invest money to get decent returns over, say, a decade to 2 decades?
Right.
What's like in this tech-driven algorithm world, investment world, what chance do I have?
You got a good chance, but you need to really define what your objective is, right? And think about it in a systematic manner. The first thing which you need to do, and I'm presuming somebody who's got no wealth, zero wealth starting on day one, the first thing that person needs to do is to secure money, right? Find very, very easy places where returns are available. So think about what are the big goals which typically anybody who is starting early in the career will have. These goals will include, some funds for weddings, some funds for travel, then hopefully some funds for buying a house, car, whatever it is. Hopefully some funds for children education, maybe a pot to take care of sickness, right? So these are broad objectives which somebody needs to kind of be mindful of, and then you need to align your investments according to your objectives. So if I'm thinking of getting married in 2 years, I definitely can't be thinking of equities from a 2-year perspective. Equities typically, you would be very lucky to make money in equities in 2 years. Equities are 5, 7, 10-year games, and if you are playing those games well, you will make money. Right? So if you're looking at that 2-year slot, what you want is really protection at reasonable yields. Right? So you would need to think of your assets or your investment strategies in those manner. Right? If you are thinking of setting aside a pot to take care of any emergency need in family, you need to be having money which is accessible not just for you but for your family members, because if something happens to you, there's no way your parents are going to figure out how to take out money from mutual funds unless they are very savvy, right? So you need to be thinking of things which are easier for them to access, right? And they're still safe and making you some money. Right? If you are thinking of your children's education 20 years down the line, there's no better alter asset class than equities, and do indexing, do SIPs, do indexing. Don't try to time the market. It is hard, right? Ironically, yesterday on my LinkedIn, top 3 PISS performances came up. The best PIS gave about 80-85% return over last year, but if you look at index has given you probably that kind of return, right? So would you want to pay 2 plus 20 fee to that PIS, or would you want to put into an index fund which is charging you 20 basis point, right? These are the kind of questions which you need to think about. And the more simplified the decision making processes, the easier your life is going to be. The second point which I would like to kind of emphasize here is that life is much more than making money. right? Your life is culmination of experiences. So if you start over obsessing about money, you're going to lose out on all of those experiences, right? So start thinking about how do you bring your life experiences into managing money, right? Put a plan in place, let the plan play out itself, and you just sit and you just watch how your money is going. That's all you need to do. Activity is not friend of money. Actually, disactivity is friend of money. Inactivity is friend of money. The unfortunate part is that none of the educational systems in the world talk about money. Nobody teaches how do you manage money. In my personal situation, I just literally got lucky with it. I got to read few really nice books at the very start of my career, right when I was in college, and that made me start early, right? A lot of people don't have that opportunity, and a lot of people are actually disinterested about money. Actually, if you talk about money, apart from Gujarati and Marwadi families, if you talk about money in a Maharashtrian family or a Tamil family or a Bengali family, you would be looked down upon. People will look at you as if you've committed a big sin by talking about money in the family. Right? These are things which are still tabooed in the society, and the best thing which you could do for your child is to start to teach them about money. Start to teach them basics about money. You don't have to teach them everything. You don't have to make them the next Warren Buffett. But even the basic things, what does saving mean? Why is it so important to save? How do you systematically start thinking about your goals in life, and how do you start to accumulate money to meet those goals?
Fixed deposits are considered the safest asset classes, or have been considered the safest ones in India, right? Gold being the other. But with the fixed deposit interest rates falling down to 6.5%, even for senior citizens, it's touching at about 6.75 to 7% today. Where do you park your money in a way by which you don't have to worry for the next 3 to 5 to 7 years?
So see again, Darshan, I'll take a step back here.
Yeah.
Right. Every financial product has its utility in life. Right. You should be looking at fixed deposits if your objectives or if your need for that money is short term, or this is an emergency fund. Again, you could use techniques like laddering, which means that you instead of doing a 5-year fixed deposit, you do a 5-year, a 4-year, a 3-year, a 2-year, and as fixed deposits mature, you just buy another 5 years. So what happens is you are then protected against swings around interest rates, right? So there are various ways in which you could optimize your fixed deposits, right? If you are thinking of 5 to 7 years, I'm presuming that this is money which you would really be wanting to do a slightly longer term objective. Equities is usually a good place to start with. It's an asset class. If you're investing smartly, makes sense. If you don't have a lot of inclination in equities, then the best place for you is to go and buy a Sensex or a Nifty ETF or an index fund and just stick with it and do a sip on it, right?
Yeah.
Those will generate you returns over a period of time. They'll go through cycles, but over a period of time, we've seen equities generate about 15% return. In fact, last 10 years were not all that great for equities because they generated about 10% return. But bear in mind, these 10% returns are tax free. Everything else in India is taxed. There are very few instruments, maybe PPF, Sukanya Samruddhi, which are triple NPS to some extent, and equities, but pretty much everything else is taxed.
Right. You talked about 10% return, 15% return. What should a person who's not a fund manager or an investor by profession, what should he or she target as a return percentage year over year?
Look, the question here is not about what you should target, right? The question is what do you want to achieve in the retirement phase, right? So, if you are happy with your current lifestyle and you want to maintain it, all you need to do is basically beat inflation, right? And inflation in India typically has ranged anywhere between 5 to 7%. So, as long as you are making plus 2% on inflation, you're going to be fine. Let me tell you, nobody is going to remember whether you've got a 20 bagger or a 40 bagger or a 50 bagger. Nobody ever does remember that. What everybody remembers is because मैं बूढ़ा हो गया हूँ, मेरे पास मेडिसिन के लिए पैसा है कि नहीं. Can I take care of my hospitalization? Can I take care of my kids' education? And if you're taking care of all of these things, all of the other things, fixating on what's my next quick money, get rich scheme, you would stop doing that. If you focus on that simple objective, you would start to rethink of risk in a different way. You'll say, okay, why do I need to take a 25% potential return risk when I know that, okay, I can live with a 10-12% risk, right? 10% return type of an instrument, and then your instrument choices differ, right? Having said that, always look at non-linearity bets, right? So what I mean by non-linearity bet is that you put a small amount of money in something, and this has potential to generate 200-300x return, right? But don't go beyond 2-3% of your portfolio around it, because you never know. These are like lottery tickets, boss. वो लग गया तो लाइफ बन गई, right? So you have to really start thinking from so many different parameters when you are looking at something like this. But the first thing is protect your future. Don't do something stupid which wipes you out, and then you have to restart from something else, right? Having that nest protected is important, and then slowly diversifying your risk. For somebody who's starting early, I say, boss, start with PPF. Nowhere in the world do you get 8% post-tax returns without taking any risk, right? If you are really, really smart, take a home loan which is at 7% and invest in PPF, right? You're straight away making a 4% spread, because home loan you will get interest deduction, right? PPF is interest free. You're making a net spread. You're making bank pay for you. There's nothing like that, right? So, if your parents are telling debt is bad, please tell them that debt which makes you money is not bad. It is good, right? Then you start taking your next steps. Once you have exhausted PPF, SSA, then you get into NPS. Then you start to think about mutual funds, or you start to think about liquidity, mutual funds, and so on and so forth, right? So you have to literally stack it slowly till you have reached a place where you've now said that, okay, I have now exhausted everything. I know that there is a set amount of income which is coming in, and I can start taking risk on the income. When I look at my personal portfolio, today all my startup investing or risky investing is only coming out of investment income. Right? I'm not even putting my proper income into some of these areas. Right? And these are, I literally look at these as lottery ticket.
Right. For a person in India who, again, sticking with middle class, trying to make generational wealth, trying to gain financial independence, where should this person invest? How do you think about asset classes and asset allocation?
Right. So we did cover about how do you kind of structurally think about it, right? Going from the lowest, easiest picking fruits, right? When you are starting to run, you want to really jump those 2-inch hurdles as against a 2-meter hurdle. Right? So as you start to kind of move up that hurdle, that's when you start to think of more riskier asset classes. Equities is a great example of it. Fairly from an Indian perspective, it's an accessible asset class. There is a lot of information which is available in the markets. All you need to do is to look into that information and start thinking about it. Even if you don't understand it, just be observant of what's happening. Now that we are sitting in Pune, if you were in Pune in 2008, 2009, you would have started to notice that there was one specific company which started to aggressively hire, right? And it started to put small branches around, right? And that company was called Bajaj Finance, right? Had you bought Bajaj Finance in 2009, 2010, with pure belief that this is somebody which is coming from a stellar reputation family, it's someone who's never at least publicly cheated shareholders, and somebody who's got its mind now put on this. If you would have just kind of looked at that and bought, you would have still made a lot of money. If I remember right, Bajaj Finance is probably 200 times up since 2008, 2009. That's the kind of wealth we are talking about. If you're looking at 1 lakh rupees put in there, which does not look like a lot of money, right? A lot of people I know now spend 1 lakh rupees on celebrating family events. Right?
iPhone.
Oh, absolutely, iPhone. Right? That 1 lakh would have turned into 2 crore rupees. That's the wealth which we are talking about. If you are observant and if you just apply your common sense, things work. Right?
So 2 questions to that. first question is, how do you identify these companies who you can build conviction in? What are the parameters that you look for?
Right. So for me, the whole process is about how do you identify stock is about casting the net wide and then filtering out things. Right. So it's literally deselection before selection. Right. And my criteria is very simple. What I want to do is, from a long-term perspective, buy great companies at reasonable prices. If they are available cheap, that's great. Then I'll just load up on them, and with management which is ethical. I'm not even looking at great management, I'm just looking at ethical management. And what you need to do is, once you've defined it, and both of these situations are defined, great companies, cheap prices are defined, right? So great companies, effectively, if you look from a corporate finance perspective, are the companies which continuously generate higher returns than capital, right? From an Indian context, typical capital cost is anywhere between 10 to 14-15%. And what you want to do is build a margin on safety of top of it. So you're looking at return ratios of anywhere between 20-25%. What you also want to do is, you want to have businesses which do not have high levels of leverage, because, as you've seen, when the economy turns around, leverage is what screws you. The lenders come in and they get you to make decisions which are not in favor of long-term shareholder value accretion. Right? So you've more or less defined what great companies are in a very simplistic manner.
I want to further go into, how do you identify ethical management? What do you?
So we'll come to it. So we'll look at all three components of it, right? So that's the first part of it. The second part of it is, what is cheap prices, right? So that's really the valuation question which is there. A lot of people who would be looking at this podcast will have difficulty in valuing companies, right? So people do not really understand DCF or a DDM model or an EVA model, right? But in reality, you can pretty much value anything in the world if you know what their cash flows are, what their growth is, what is the risk which they are taking into the business, right? Between these 3 or 4 components, you should be in pretty much using an annuity formula able to value most of the things. Right? Having said that, you could even do a simpler object, right? You could look at the historical price to equity or price to book value or EV to EBITDA bands, right? See what is the top quartile of that band, see what is the bottom quartile of that band. If the stock is at the bottom quartile, buy. If the stock is at the top quartile, sell, right? It is just a simplistic way of looking at it, and it works beautifully, by the way. A lot of times you really can't and we can get a lot technical in terms of how you value companies. There are many ways in doing that. But this is what you would do, right? And then the third part comes in, which is the most difficult part, which is, how do you judge management is ethical? Do you judge management ethical by just what people are saying, that, hey, I am ethical? That way I can always come and say, hey, I am Amitabh Bachchan, right? It never works that way. So what are those qualitative parameters? That's where you need to dig deep into research, right? You need to literally start looking at whole bunch of news articles, seeing what the management has done in past. Are there news? Are there rumors which have been floating around? See what is the stock trading data. By the way, this is available on BSE NSE's website. How many circular trades are happening? How many block deals are happening? Are there same entities which are involved, not involved? Right? What's happening with third-party transaction or related party transactions? How is cash getting utilized? Is the management giving the cash back to the shareholders, or are they using it to buy company guest houses, to buy property in name of company, and then obviously using it for personal use? So you look at a lot of these small things, and whenever in doubt, you just run away from them. Right? Also believe in cockroach theory. There is never one single cockroach in kitchen. The moment you find one cockroach, please be assured there is an army of cockroach behind it. Same goes with companies. This is never a single company or a single issue with the company. It will come with multiple issues which are hidden from sight now, where at some point in time they will come to play. Right? So if you are able to basically look at these companies, and if ironically, in Indian universe, there are probably not more than 20 companies which fit that criteria of great companies and ethical management. Prices is something which are market driven. So you really can't control that. Right? So if you limit that universe, you really know what you want to buy, and then it's patience game. Then you just wait and wait and wait when the prices are right for you, and you buy, load them, and you wait, and wait till your objectives are met.
So let's take an example. You spoke about the MRF example. Maybe you can just share that again.
Oh yeah, this one was an interesting one. I was seeing CNBC program where viewers typically ask TV channel host about a specific stock. So somebody asked TV channel host about what do they think about MRF, right? And the TV channel host started talking about it, and at the other end, this guy was also talking. The viewer was also talking, and then while talking, he said, my uncle had bought this stock, and my uncle had bought X number of stock. And this was in 92, and then he met an accident, he went into coma, and after 20 years he's out of coma. We really don't understand what to do with the stock. Suddenly the TV host realized the value of that stock was 2000 crore. Right? And his reaction on camera was priceless. That somebody just realizing what is he talking about, right? And this is what stocks can do, that's the beauty of it. Bajaj we spoke about earlier, 200 times return is an unbelievable return. No asset class gives you that kind of return. HUL is a great example of it. If you looked at HUL stock, let's say between 2004, 2008, when every stock was generating supernormal returns, HUL just didn't move. It was within a band, right? Yes, of course, in 2004, 2005, it was expensive. But what it did was, it was a superb compounding machine, generating 90-95% return on capital. Effectively, the company was doubling its book value every 1.5 years, right? So over a period of 4 or 5 years, the stock became cheap. Believe it or not, it was available at 16-17 PE. It was a no-brainer buy there. And people didn't buy it simply because they believed that HUL will never move.
Yeah. This has been a fantastic podcast, Mandar. Thanks a lot for joining us at DASAR.
My pleasure, Darshan, and thanks for having me over.
Fantastic. So I hope you guys have found a lot of value in this podcast. I've had a lot of fun in this podcast. There's so much to learn. This is part of the investment series that we are running on DASAR. For those of you who are new to DASAR, we run a podcast which you'll find on YouTube, you'll find on Spotify, TuneIn, Stitcher, Google and Apple podcasts. You'll find a lot of writings, writings not just from me, but from curated from some of the best people in the world on startups, wealth, investment, development, fitness, and sports. Right? So you can go to www.dasar.in. And lastly, we've just launched an online program and an online community which you can be a part of. It's a private community for people who really want to achieve their health and wealth goals. So log in, check it out, and reach out to us if you'd like us to do something of interest to you. Thanks a lot.